If you're a longtime listener of this podcast, you already know J.L. Collins, the author of A Simple Path to Wealth. We're going to interrogate him today. Welcome to the Afford Anything podcast, the show that understands you can afford anything but not everything. This show covers 5 pillars: financial psychology, increasing your income, investing, real estate, and entrepreneurship. It's double I fire. I'm your host, Paula Pant. I trained in economic reporting at Columbia. Welcome, JL.
It's a pleasure to be here with you, Paula.
It's great to be here with you. This is your second time on the show.
I know.
And since this audience already knows you, we're going to skip over the basics because we talked about that in your first appearance.
Yeah, that works.
And we'll put a link in the show notes for anybody who doesn't yet know you or your material. We'll put a link in the show notes to the first interview that we did so that people who are newer to this community or who are unfamiliar with your work can get briefed on the basics there. But we're going to dive right in
and start grilling me from the get-go.
Exactly. Yeah, and we're going to go advanced level right from the start. You're Mr. VTSAX and chill, is how a lot of people regard you. Are you familiar with the efficient frontier?
No.
You're not?
No.
Okay. You've never heard the phrase?
I think I've heard the phrase, but I can't tell you what it is, so I can't speak to it.
Oh, interesting.
But if you can brief me quickly, we can delve into it.
Essentially, the concept is that what you teach is the simple path, which is different from the most optimal path. That there is a distinction between what is simple and what is optimal. And so if a person is a beginner, or if they're intimidated by the market, or if they have assets of less than $100,000, sure, it makes sense to begin with a simple approach because it gets you in the game. But once you are an enthusiast, you're excited about this stuff, you're ready for complexity, or you have a larger portfolio, let's say over 100,000, maybe you have 500,000, maybe you have $1 million, it makes sense to take the time to do something that is a bit more optimal. And so the efficient frontier is a curve, basically, that was designed by Harry Markowitz to plot the asset allocation that would be used for determining the mix of various types of asset classes that should be in a person's portfolio.
Got it. So that makes sense, and I would argue that the most optimal is the simplest. So I would disagree with the idea that if you make it more complex just because you have more money, that you're improving your performance. So when I wrote The Simple Path to Wealth, I wrote it basically for my daughter. I wrote it for people like her who are very smart, but they have better things to do with their life than obsess about their investments. And the beauty of the simple path and the fact that it's so effective is that you just have to understand a couple simple things and implement a couple of simple moves and then sit back and forget it. Now, as I've written the book and I've written the blog, I've discovered I have 2 audiences, right? I have people like her who respond to it at that level and figure it out and engage it and step away. And then I have people like you're describing who love to tinker. And I've learned I'm never going to dissuade people who want to do that from doing it. But I would be willing to bet that if you got 20 years and you look at my daughter who's not tinkering and you look at those who are, the performance will fall on her side of the ledger. Because the more you tinker, and this, by the way, not just me saying this, these people like Jack Bogle saying it, the more you tinker, the worse your results are going to be. Based on the way you described it, I'm not a fan of the efficient frontier.
There are those who would argue it doesn't take a whole lot of additional time, and it doesn't require tinkering, as you describe it. It simply requires an extra 15 minutes and a commitment to adding 1 or 2 additional asset classes to the portfolio. Maybe some small cap value, a little bit of international, but a couple of asset classes, 15 minutes, can make a big difference over the long term.
So what you just described there is what Paul Merriman talks about. Paul's a friend of mine. And Paul and I have debated this actually on a podcast. And I think Paul's an extremely smart guy. And he's done the research. And he has, as I recall, a 4-fund portfolio. And it includes international and small cap. And he tells me that it outperforms my simple path of just doing VTSAX and maybe a little bit of bonds. And I take Paul at his word. I believe that is probably true. The challenge is I have enough trouble getting people to stay the course with just VTSAX, right? The idea that somebody is actually going to take those 4 funds, faithfully rebalance them over the course of, say, 20 years, which is going to require them, by the way, to be selling the ones that are performing best to buy in the ones that are lagging. That just goes so much against human nature from my experience that I don't think anybody is ever going to execute that. So that's another reason that I'm not particularly in favor of it. So again, 20 years out, there will be tinkering that happens with that. Unfortunately, there's people who tinker even with the simple path, just holding that one fund. Every time the market drops 5%, my social media and my blog light up with people who are in a panic and should I sell now? Should I step to the sidelines? I just don't see people executing what theoretically might be a better approach.
Would you agree with the statement that an approach like Paul Merriman's is mathematically better?
Yes. And I conceded that just now, and I conceded in my conversation with Paul. And I am trusting his numbers on that. Paul's a very trustworthy guy. When he says, I've run the numbers and this is what they show mathematically, I accept that. I believe that's accurate stuff. But again, it's a matter of execution.
So I'm going to, and I usually don't do this, but because you are so well known in this community, I emailed some of my newsletter subscribers, not all of them, but I emailed the 2,000 most engaged newsletter subscribers, the ones who have opened the greatest volume of
heavy hitters.
Yeah, exactly. The ones who have opened the greatest volume of emails that I've sent. The software has like an engagement score. So the ones with the highest engagement are the top 2,000 are the ones that I emailed.
I'm in trouble now.
And I said, hey, I am going to be speaking with J.L. Collins. What would you like me to ask him? So
here we go.
Actually, that first question, I want to give a shout out to Ricky because Ricky said, ask him what the efficient frontier is. So thank you, Ricky, for that question.
And Ricky for showing me up that I didn't know.
But the next one comes from Patrice. And Patrice says, I think it might be neat to ask him what he thinks of the risk parity approach to investing. Or is that something that you're familiar with as well? So that Frank Vasquez?
I confess I'm unfamiliar, but educate me.
Risk parity is Frank Vasquez's approach to portfolio decumulation.
Okay.
So it is...
So I think I know what this is, but please go ahead.
Yeah, it is different from the efficient frontier. It is more complicated than the efficient frontier. I myself really struggle to understand what risk parity is in its fullness. But it is a complicated approach to portfolio decumulation.
Okay.
That is championed by Frank Vasquez.
So it's hard to speak to it because I'm not entirely sure I'm understanding what it is.
Yeah, I'm not entirely sure I'm understanding what it is either.
But I will say to Patrice that just the fact that it is that complicated that we're having this part of the conversation, the more complicated things get, the more expensive they tend to get, and in my way of thinking, the less effective they become. What I thought you were talking about, this idea that when you enter into retirement, you load up on more bonds than you might ordinarily do, with the idea that you're trying to mitigate the idea of a sequence of returns risk, which simply means that the stock market goes against you in the early years of your retirement when you're living on the portfolio, and that would be a bad thing. And by loading up on bonds, you smooth that ride a little bit. And then as you get past that, out 5-10 years, you begin to shift more and more into stocks because you're in a little safer ground and you can afford to be a little more aggressive. That is an interesting concept to me, and that is something that I think has merit. If that's what we're talking about, then I think that's worth considering. But it sounds like it might not be.
There's an approach to sequence of returns risk that is championed by Dr. Wade Pfau. Dr. Wade Pfau is a professor of retirement planning, and he talks about an approach to sequence of returns risk in which, at the very beginning of retirement, you significantly decrease your risk exposure. You load up on a lot of cash equivalents and a lot of bonds. But then, after you get into the first 4 or 5 years of retirement, you actually increase your equities exposure.
Yeah, just what I was talking about. And again, I think there's merit there.
Yeah, exactly. Yeah. So that's the Dr. Wade Pfau approach. And actually, I advise my parents to do that, so I'm a big believer in that as well.
Well, and he's a very astute guy. I'm a fan.
It's funny how we're, in this conversation, associating all of these approaches with specific people. You know, where J.L. Collins is the VTSAX and chill guy. That's a reputation that you've earned. We've got Paul Merriman as the for-fund approach. We've got Frank Vasquez for risk parity. We've got Dr. Wade Pfau for the sequence of returns glide path.
Right.
I guess because these are such heady concepts, it's attractive and tempting to associate each philosophy with a particular person.
Sure.
To kind of humanize the idea.
Yeah. It's interesting to me because, of course, I'm a proponent of what Jack Bogle created, right? Mm-hmm. And I started investing in 1975, which coincidentally was the year that Bogle created Vanguard and the first index fund that retail investors, normal people like the two of us and our listeners, could invest in. And I didn't know that at the time. It took me another 10 years to learn about it, and then I was slow to pick up on it and accept it. Sometimes people put my name in the same sentence with Bogle's, and that's a high compliment for me. But I always say if I've lit a candle in the darkness, Jack Bogle's a white-hot sun, right? I talk about the things that he pioneered, that he created. So I'm flattered to be associated with VTSAX, but I'm not the guy who created the fund or the concept.
Right. Did you meet Jack Bogle before he passed?
Didn't meet him personally. Kind of an interesting story. I was in Ecuador back in the days when I was doing Chautauquas.
Yeah, you and I were in Ecuador together.
We were. You were a speaker. I forget which year you were there.
I was there for 3 years.
Yeah, okay.
Yeah.
And so, or the early years.
The early years.
Like 14, 15, 16, something like that.
Somewhere in that neighborhood,
yeah.
ballpark.
But anyway, one of those years, Jane and I can never remember the name of this little town, which is a shame because I loved it. There's a little coastal village in Ecuador that I particularly like. Haven't been there in a number of years, but I used to spend quite a bit of time. And she and I were there before Chautauqua, and we were checking out of the hotel, getting ready to travel into the mountains where we had Chautauqua. And I thought, well, before I leave the hotel and lose my Wi-Fi, I'm just going to check my email one last time. It happened, by the way, to be my birthday, November 1st. And so I'm open up my email, and I have one email. And it's from Jack Bogle. And I actually have a blog post about this. I don't reproduce the email he sent me, but I do reproduce my response. And he's telling me that he's read The Simple Path to Wealth. Wow. And very generous in his comments about it. I'm not a person prone to having heroes, but Jack Bogle is a hero. Jack Bogle's a fiscal saint. And my wife teases me to this day. She said, you were like a 5-year-old at Christmas. Wow. You were so excited. And how that came about, incidentally, is Taylor Larimore, who I believe is the guy who founded Bogleheads, early on sent me an email, and he had done a review of The Simple Path to Wealth on Bogleheads. Again, extraordinarily generous review, and he sent me an email to share it. And, of course, I responded and thanked him, and that began a correspondence. And his personal friends was when Jack was still alive. And by the way, Taylor, I was talking to somebody this week who just turned 100 years old, which is amazing. But anyway, in the course of chatting back and forth with Taylor, I've always been curious. I said, does Bogle have any concept that the book is out there? And Taylor said, I don't know, but next time I talk to him, I'll ask. And reading between the lines, I think he took the time to look at the book, and that generated the email that made my birthday.
Wow.
Yeah, probably the best birthday present I've ever had.
Wow, that's incredible.
Yeah.
Wow.
Pleased to be associated as Mr. VTSAX, but even more so to be a messenger for what Bogle has created.
Wow.
Yeah.
I want to go back to some of the listener-submitted questions. Right. And the next one actually happens to be about VTSAX, as well as Vanguard's comparable ETF, VTI.
I've never heard of that. Can you explain those to me?
VTI is just the... wow.
Finally one that you don't have to explain.
This question, which was submitted from the listener, says, in the grand scheme of things, does it really matter if you invest in VTI over VTSAX? I understand one is a mutual fund with one daily price, and one is an index ETF with a fluctuating price. But I don't really understand why VTSAX would be the preferred choice.
So a great question, and it's one I get a lot, and I'm actually going to expand that question a little bit in my answer.
Okay.
So to answer his question specifically, no. It's the same. It's the same portfolio. I'm associated with VTSAX because I'm an old guy, and it came before ETFs were out there, so I'm in VTSAX. There's absolutely nothing wrong with being in VTI. And candidly, if I were starting now, I would probably buy VTI simply because it's a little simpler to buy and sell. But from a portfolio point of view, and if you're following the simple path to wealth, you are going to hold either of these things forever. So I don't care that when you buy or sell VTI, you get the price at that moment, like when you're buying or selling a stock. Whereas with the mutual fund, you get the price at the end of the day. It doesn't matter to me because I'm holding this thing forever. But it's the same portfolio. Now, the way I'm going to expand that is the other part of that question I get is I'm with Fidelity, and I like Fidelity, or I'm with Schwab, and I like Schwab. And they have a total stock market index fund, which is what VTSAX is. Is that okay? And the answer is yeah, absolutely. I have a preference for Vanguard for reasons we can get into if you like. But a total stock market index fund is essentially the same wherever you buy it. They might track a little different index, and it might be a little different, but performance-wise over time, it's essentially the same. So if you're comfortable at Schwab or Fidelity or somewhere else, and they have that, absolutely no problem. Go for it. And let me just take it one step further, because this is the other part of that question I get a lot. And typically this would be, well, I'm looking at my 401k, and there is no total stock market index fund, but there is this S&P 500
That's
fund.
Exactly what I was about to ask.
That's where you were going to go.
That was literally what I was about to ask.
We're clairvoyant. You don't have to ask. I don't have to answer. We just can do this. But for the benefit of people listening, yeah, they have this S&P 500 index fund. Would that work? And yeah, absolutely. So what you need to understand is that these funds are cap weighted. And all that means is that the bigger the company, the bigger percentage of the fund it represents. And so the S&P 500, as the name suggests, is the 500 largest U.S.-based companies. And because these things are cap weighted, that is going to be 80, maybe 85% of VTSAX, the rest being made up of mid and small caps. And if you track the performance of those two funds over time, the lines mesh together, essentially. They are so close in performance. There are going to be times when large caps outperform for a while, and so the S&P 500 might do better, and there'll be times when the small and mid caps are strong, and that might boost. But essentially, over the periods of time you're going to be holding these things, it's the same thing. And then the final part of the question I get is, well, then why are you in VTSAX specifically? And my answer is it's the same reason I put Tabasco on my eggs. It's just a little extra spice.
As opposed to Cholula or anything else.
Yeah, well, Cholula is also spice as opposed to just salt and pepper, I would suppose. Yeah.
There was an argument, we don't hear this quite as much anymore in the post-tariffs era, the post-Liberation Day era, but particularly in early 2025, we would often hear the argument that cap-weighted indexes comprised so heavily of the Magnificent Seven, the Mag 7, that you essentially lost a lot of diversification because so much of your portfolio hinged on just those 7 stocks, you know, like NVIDIA, Tesla, Apple, Alphabet, Meta, these were the market. Starting from that premise would make a number of arguments. Some people would argue that you therefore needed to counterbalance with more small cap. Some people would argue that you therefore needed to be in something like an equally weighted fund rather than a cap-weighted fund. Can you talk about your response to, we'll say, both of those arguments and other arguments that you heard from people who criticized the lack of diversity inside of a total stock market index fund?
Sure, that's a great question and very pertinent. So the criticism is seeing it as a bug. I see it as a feature. So basically people are saying you look at VTSAX or the S&P 500 for that matter, and it's really because of this cap weighting and this dominance of tech companies. It's a tech fund. It's become a sector fund. And that's true to a certain extent, but there's very few things, Paula, very, very few things in my experience that are good about getting old, being an old guy. But one of them is that I can remember times when tech didn't dominate, when it was dominated by financials, when it was dominated by energy, when it was dominated by consumer staples, right? So what's at the top of these funds, what is the top sector in the economy at different points in time is different. And the reason this is a feature in my mind is a process. This is one of the reasons I love broad-based low-cost index funds is they are self-cleansing. And that's a term I coined to describe actually the way they treat individual stocks, but it applies to sectors. And all that means is that the strongest stocks, and by extension the strongest sectors, are like cream. They're going to rise to the top. And I'm going to benefit from that, and I'm going to own them. But these things are cyclical. Companies and sectors have lifespans, right? And I don't know when that shift is going to take place. I don't know what's going to replace any given stock that's at the top now or any given sector, and I don't have to know because whatever it is, I will own it by virtue of owning these funds, and it'll rotate ahead. So I'm become a little bit notorious, I gather, from my Google talk back in 2018 when one of the questions was, I've got it from the audience, and of course they're all Google employees, was I got a lot of Google stock that I've earned here, and should I hang on to that? My answer was no. I didn't think anything of it at the time, but evidently it was kind of a bold thing to say at Google in front of a bunch of Google employees. But the reason, and what I said at the time is Google's a great company, and it's probably going to be a great company for a long time. But at some point, some competition is going to come along and eat its lunch. And that's sort of hard to accept. Right?
Well, I mean, we're already beginning to see that with AI.
We're beginning to see it. But back in 2018, there was no glimmer of this. Jeff Bezos, actually, and kudos to him, said a number of years ago that someday that's going to happen to Amazon. Mm-hmm. And he said, my job is to delay that as long as I possibly can. So for those who think that Amazon's so hugely dominant, Google's so hugely dominant that you're always going to be the top companies, I give you Sears. Now, there may be people listening who don't even know what Sears is, and that's kind of the point, but just a little history lesson, if you'll indulge me. Sears was the Walmart and Amazon of its day combined, a retail company that was started in the late 1800s, and it was brick and mortar stores to begin with, and somebody at Sears said back in the day, there are a lot of Americans living out in the countryside, rural America, and they don't have access to stores. But you know what we could do? We could send them a catalog with all of our stuff in it, and then they could order stuff out of that catalog, and we could mail it to them. What does that sound like? That's Amazon. And at the same time, we're going to have brick and mortar stores. Sears dominated for 100 years. In 1973, they built the tallest building in the world, the Sears Tower
in Chicago. Yeah.
Tallest building in the world at that time. Hugely dominant in that space. Try to find a Sears store open today. If in 1973 I'd been being interviewed, and I wasn't, and I'd said Sears is not going to be here forever, people say, you're crazy. It's been here for 100 years. What are you talking about? Going back to our fund, if I was owning, and of course these index funds didn't exist then, but when Sears was part of it, as Sears began to fade away, and Walmart and Amazon began to grow and grow, I didn't have to worry about that happening. I didn't have to predict it, either that what's going to happen to these individual companies or in that space. I benefited. Going back to the original question, with the tech domination, I'm benefiting from it. All of us who own these funds are. If someday in the future that changes and something else dominates, I don't have to predict that. I don't have to worry about it because whatever is coming up behind it that replaces it, I'll own. That's why I think it's a feature, not a bug.
I'll add to that Blockbuster video.
Great example.
It used to be synonymous, just the term Blockbuster was synonymous with a company so big that it could not be disrupted.
Absolutely. And it disappeared almost overnight. That was stunning.
Exactly.
And to your point, nobody would have predicted that.
My favorite example is the Dutch East India Company. Right? If you want to go way back
That's
in
classic.
history, right?
Yeah.
Quite literally, we live in geographies today and in nations today that are based on decisions made by the executive team at the Dutch East India Company.
Yeah.
And it no longer exists.
In many ways, that was the beginning of modern capitalism.
Right.
And modern capitalism has transformed the world into a far better place. I mean, we are living longer, healthier, less poverty, more wealth throughout the world than ever before. And it started with that kind of thinking. Was it Galileo or one of those brilliant people of all time in history was alive at that point, and he saw the bubble in that. He owned the stock and he sold, but then it kept going up. He doubted himself and he went back in at the higher price, then the bubble burst. I wish I could remember who the hell this was, but he has some great quote about how I can predict the movements of the heavens, but nobody can predict what the market is going to do.
Wow. Speaking of the Dutch East India Company, so this is also a listener-submitted question.
Yeah.
This person asks, quote, "You've always said you prefer U.S. stocks. Can you imagine a time when the U.S. is no longer a world power and it would be wise to have more allocated to international stocks?"
Another great question, and the short answer is yes. So when I talk to international audiences, I sing a little bit different tune, because the U.S. is the only country in the world where you can safely have that home country bias that I recommend for those of us in the U.S. And the reason for that is the U.S. accounts for about 60% of all equities in the world, right? So you already own a big slug of the world. The other reason is that those large companies that dominate, because it's cap weighted that we talked about, are international companies. So I expect the world to continue what it's done since World War II, which is to grow and expand and continue to prosper. At the end of World War II, the economy was essentially in the United States because everywhere else was in ashes. At least all the industrialized countries were in ashes. And then through the Marshall Plan and what have you, we began to help rebuild them, which was to our great benefit as well as theirs. Those countries got back on their feet, and their economies grew and prospered. It's made for a much wealthier, healthier world, and that's a great thing. I expect that trend to continue, the trend being the pie getting bigger with more prosperity, and those other countries doing steadily better, and perhaps the share that the U.S. represents will begin to shrink. So when I'm talking to international audiences, if I were in any other country in the world, I would already be buying a world fund, because I wouldn't be entirely comfortable investing in another country that wasn't my own 100%. And also, I think that's where we're ultimately going. So at some point, my advice will probably change even for people in the U.S. to go to a world fund. I don't think this is happening anytime soon. I think the U.S. is so dominant. That dominance is going to last probably for my lifetime, but again, remembering I'm an old guy. But when I talk to my daughter, who's in her early 30s about this, and she's 100% in VTSAX as per my recommendation, this is something I say, you want to keep an eye on this, because at some point you might want to start to transition. Now, my opinion of not needing international stocks might be the single most controversial opinion I have, the one that is most at odds with the vast majority, in fact, as far as I can tell, everybody else who talks about this. And so frequently people will say to me something along the lines of, well, JL, I understand what you're saying, and I understand why you don't feel the need for international. I hear you, but I kind of still do. I think I do want to add international into my portfolio. You're not going to get a big fight from me. If you feel that way, go for it. I don't have any problem with it at all. I kind of look at you and say, you're probably a little bit ahead of the curve, in my opinion. You're probably moving a little sooner than you need to. But by all means, it's not going to be a bad decision. At the end of the day, you're still going to do very, very well. And by the way, rolling back to our early part of a conversation, that's also a point that's worth making. If you follow, just to take one example, Paul Merriman's approach, the four-fund approach, it's not like you're going to do badly. And as I've already said, if you actually faithfully follow it, you might even do a little better than what I'm recommending. That's be a challenging thing to do. But the key is to be invested and engaged and staying the course over time. So all of these things will get you there. I think my approach will get you there more reliably and certainly more simply, and it's a little easier to weather the ups and downs that can be so traumatic. But it's not like these things are bad choices. So if you add international and that makes you more comfortable, you're not making a bad choice, and you won't get a great argument from me. I just don't see the need.
When you talk about a world fund, do you mean total international?
Yeah. So, again, I'm a Vanguard fan. I can't think of the ticker, either the ETF or the fund offhand, but Vanguard has a world fund. And the distinction is a world fund includes the U.S., so there are a lot of funds out there that are ex-U.S.
Right.
So if you're in VTSAX, for instance, and you want to add the rest of the world, well, there are funds that do exactly that. My recommendation currently today to my international readers is make your life simple, buy a world fund. Then it's taken care of. And then also, because right now the U.S. is, as I said, about 60% of that fund. If that shifts, the fund will do that for you automatically. If China, which has a surprisingly small stock market, by the way, but if that increases, that'll shift automatically. And so that's where I would go. I don't see the need to complicate your life with two different funds. Now, an exception to that, by the way, is if you were holding VTSAX, let's say 10 years from now, you see the trend that I was just talking about evolving, and you say now it's the time to go international, and you're in a taxable fund. Well, you're probably not going to sell your VTSAX and take the big tax hit in order to go into the World Fund. And that would be a case where you could just add the International ex-US Fund and do the balance. But if I'm doing it inside an IRA or a 401k or something, I'd probably just go ahead and make the switch to the World Fund and keep my life simple.
Do you have any recommended allocation when that time comes?
Well, again, I think the World Fund itself allocates it pretty well, because it allocates it based on the size of those individual markets. So if you buy Vanguard's World Fund, and my memory, Paul, isn't good enough to tell you other than the U.S., you're going to get 60% U.S. You're going to get, I want to say, 30% EU, probably another 25%, something like that, in the Asian markets.
Oh, so you would go entirely, you would make the switch entirely from VTSAX to world, including U.S.
Barring a tax implication of
right,
doing
barring
that.
the okay.
Right. Yeah,
wow.
absolutely.
Okay.
Right. So again, if I'm
so you would still be essentially having
one fund.
Yeah, one equities fund. You have one equities fund portfolio.
Exactly. That's the beauty of a world fund.
Jeez,
right? It
wow.
just makes your life so simple. And then as the world evolves, you'll benefit from that.
What would be the indicators that would signal that it's time to make that move? What would be some examples of those indicators?
So again, if you look at the trend from World War II, right, you start with the U.S. essentially, and I don't know the exact number, but it had to be close to 100% of the world economy at that point, right? But now we're at 60, and just looking at stock markets, by the way, not necessarily economies, because China's a very large economy with a fairly small stock market, right? And of course, we can only buy publicly traded companies, right? So that's the way I tend to look at it. And right now, the U.S., which might have been close to 100% of the world's stocks available at the time, is now 60%, because the rest of the world has come up. That's the trend that I would follow. To say, does the U.S. portion get down to 55, 50, 45? Maybe once it gets down under 50, I begin thinking about making a shift. Again, I don't see this happening anytime soon. This is not like the daily trading in the stock market where it fluctuates dramatically. Right. This is going to be a gradual, barring some sort of unforeseen economic change, would be a gradual kind of thing that you can pretty easily keep your eye on. If and when you decide to pull the trigger is sort of a personal decision, but that's the kind of thing that I would look at. And so that's why I say maybe it's 60%, which is where we are today. You say, you know what? Yeah, I think I want to pick up that other 40%, so I'm going to do that World Fund deal now. And that's why you won't get any pushback from me. Yeah, but if we were still at 80%, I'd say, yeah, you probably don't want to do that.
Would you add in a world bond allocation as well?
Bonds are an interesting thing. In my world, you add bonds when you're living on your portfolio. Because when you're growing your wealth, if you're following the simple path, you are shifting part of your earned income, hopefully a significant part, into buying your freedom, which you do by buying assets, and in particular a total stock market or an S&P 500 fund. And you're putting money in on a regular basis, depending on how your income flows in, so weekly, monthly, whatever it is. That smooths the volatile ride of the stock market for you, because you're going to keep dumping that same amount of money in every time. As the market plunged back in February, March, whenever it was, went down about 20%, well, you would have picked up shares at a bargain price. That's how it smooths the ride for you, right? So if you're doing this, market drops become something that you not only don't have to worry about, but they become your friend. You're buying things on sale. But when you're living on the portfolio and you no longer have that earned income that you're channeling into your investments, most people are probably going to want something else to smooth the ride. And that's the role that bonds play. So circling back now to world bonds, I think I'd be more comfortable just being in U.S. bonds, because the world bond market gets a little bit squirrelier, a little bit tougher in regulation. Mm-hmm. So that would be my preference, and probably for an awful long time.
Yeah, many countries have higher default risks.
Yeah.
Greater risks generally, although you are seeing now Treasury yields spike.
They are indeed.
So there's quite a bit of risk, even with U.S. bonds these days.
Yeah, well, I doubt that there's quite a bit of risk in Treasuries, but it's not moving in a great direction. Was it Moody's that just recently
Moody's downgraded the U.S.
and they were the
rating.
last of the three big credit raters to do it.
Exactly.
So, by the way, that indicates that's not a huge change, but it's certainly not something that you want to see happening. But it goes back to the old analogy of what's the cleanest shirt in the dirty hamper. While I wish our credit was a little more pristine than it's become, it's still the most pristine in the world, and will probably be that way for the foreseeable future.
Yeah, it is, but we're seeing interesting correlations that have historically existed start to get broken. So we're seeing Treasury yields spike at the same time that stock prices drop, which is not something that we typically ever see. I mean, we saw it a little bit in 2022, but other than 2022, that's typically just not something that we normally see.
Yeah.
And it's the type of behavior that you would more often find in a place like Argentina.
Yeah, 2022 was remarkable. It was one of the all-time, and might even be the single, you could fact-check me on this, might be the single worst year for bonds in history.
Right.
But if it wasn't the worst, it was right up there at the top.
Yeah.
And it was dramatic.
Certainly the worst in my adult life.
Mine too, and I'm a little bit older.
How old are you?
I'm 74.
Oh, well, happy birthday.
Well, I'll be 75 the next birthday, so November 1st you can wish me happy birthday. But yeah, I haven't seen anything happen to bonds like it did in 2022. But I still think they can play the role that we're describing. And of course, back in 2022 when that was happening, my social media and blog were lighting up with our bonds over. And I said, well, let's roll back the clock a little bit. And if you go back to 2000, you had the tech crash, and the market dropped about 46%. And then in 08-09, you had that debacle, and the market, I think, got the lowest was 56%, if I remember correctly. And in that decade, the first decade of this century, the stock market returned a negative 0.63, which doesn't sound terrible, but it's not great. It's a negative return. And so a lot of people look at that as a lost decade. I look at it as a great opportunity. If you were following the simple path, you would have been accumulating shares of VTSAX for an entire 10 years at bargain prices. And if you'd gotten to say 08 or 09 and said, this has been a terrible decade in stocks, I'm done. So these stocks are over, and thrown in the towel, you would have missed one of history's all-time great bull markets that we've had ever since. So Yeah, you shouldn't panic and sell when something bad happens to an asset class. That's kind of a natural part of the process. So I'm not overly concerned about what's going on with bonds.
We talked a little bit earlier about VTI. What do you think about all-in-one ETF funds, funds of funds?
So target date fund is a fund of funds. And so it has bonds and stocks, and it has international stocks and international bonds. And as it gets closer to its target date, it shifts the allocation to be more conservative, which is to say more bonds. And then there's a very similar fund of funds, and I can't think off the top of my head what they're called, but it's the same concept where they'll have international bonds, international stocks, U.S. the same, and typically cash, like a money market fund, but it's not linked to a date, so that portfolio allocation doesn't change. So if you want something that holds a particular allocation, you can buy it that way. I think those are great options if you've got to buy one fund. And then maybe when you're living on the portfolio, you got a second bond fund, and that's so complex. And then you're going to want to rebalance those two funds. If that's too complex for you, if you really don't even want to think about that, then I think a fund of funds, a target date fund, or one of these others that the name's eluding me for, that's not the best option, but it's a viable option. And as we talked about a moment ago with some of these other options, it's not like they're going to be a bad choice. It'll serve you well. And the key thing, the most important thing, is that whatever approach you use, whether it's Paul Merriman's or mine or a target date fund, is that you stay the course, you continue to pour money into it, and let it do its work for you. Because time is your friend and compounding is what you're looking for.
You know, it strikes me that your approach is essentially a one-fund portfolio while you're in the accumulation phase.
Correct.
And then a two-fund portfolio while you're in the decumulation phase.
So you probably won't decumulate because actually it's probably going to continue to grow. But yes, when you're living on the portfolio.
Exactly,
Yeah.
yeah. And that's actually a one-fund / two-fund portfolio, which is
Right.
what you advocate,
Right.
is not that far off from a four-fund portfolio,
No.
which is what Paul Merriman
Exactly.
advocates.
And that's why I don't have any strong argument against what Paul's recommending. If you were interviewing Paul, he would say the same thing. He'd say, hey, I think what I'm doing is optimal, and here's why. But if you're not quite comfortable with that and you're looking at J.L. Collins, you're going to be fine. One of the challenges, by the way, that I get with this one fund idea is people say, well, that's not diversified. Isn't diversification important? And my response to that is, well, first of all, you're correct. It's not diversified in that it is strictly equities, which is what we want when we're building our wealth, because there is no more powerful growth tool available to us than stocks. But when it comes to equities, it's extraordinarily diversified. I mean, VTSAX holds something like 3,600 different publicly traded companies. You own VTSAX. And in every company, 3,600 companies, from the factory floor to the CEO, they're working to make you richer. When I first started investing, when indexing was new and I didn't know about it, the idea of a diversified portfolio was something like you want to pick about 8, maybe 10 sectors, and you want to pick 1 or 2 companies in each of those sectors because nobody can really follow effectively more than 15 or 20 companies, and you'll be plenty diversified. So when I can, with one fund, own 3,600 companies, I feel I'm pretty well diversified.
Yeah, 15 to 20 companies is not diversification at all. I mean, it's actually a very, very small basket.
But it was back in the day.
Man.
That was the very definition of it.
Wow.
It was realistic because if you're owning individual companies, the problem with owning individual companies is now you really have to pay attention.
Right.
With VTSAX, my holding period is forever. And then my heirs, the holding period will be forever because it's self-cleansing. So back in the late 60s, early 70s, and I was riding dinosaurs around and what have you, there was a concept called the Nifty 50. And the Nifty 50 were simply the 50 largest, most successful U.S. companies. And the concept was all you had to do was buy these 50 companies, put your stock certificates, by the way, that was actual paper certificates that they would mail to you showing that you own these things. Put them in your bank and you're done. You never have to make another decision. The problem is, as we talked about earlier, with Sears as an example, Sears was in the Nifty 50, Polaroid, probably nobody listening to us knows who Polaroid was, Xerox, all these companies.
Kmart?
That were hugely dominant at the time, have come and gone to be replaced. So if you own the Nifty 50, there'd be probably a few companies that were still around, but it would not have served you well over decades. I used to say, if you look at the Dow Industrial Index, 30 stocks, right? Everybody knows the Dow. I think it was originated sometime in the late 1800s. And I used to love to ask the question, so how many of those original companies you still think are on the Dow today? And the answer when I first started asking that was one, and it was GE. And this is back in 2011, 2012. Well, GE has since fallen off. So there's not a single company in the Dow that was there originally. And that goes back to what we were talking about earlier. Companies come and go. Sectors rise and fall. And the index fund takes care of that for you.
I want to return to some of the questions that our listeners submitted.
Okay.
This question comes from Chen. And Chen asks, would you invest differently if you've won the game and you plan to retire soon?
Oh, Chet, I love this question. So there's two schools of thought, right? When you say you won the game, that means that, in my mind, that you reach financial independence and then some. You are comfortably into that range, right? You've got plenty of money. The common wisdom at that point says stop playing the game. And what that means in our context is you don't need to own these risky, volatile equities anymore. You can go to bonds or you can go to treasuries. The classic example of this, by the way, is Ross Perot. So anybody who was paying attention a little bit to history, Ross Perot was a very successful tech guy in the fairly early days. He accumulated, I want to say, about $3 billion, which was real money back then. He ran for president, and he had won the game. And he famously went 100% into treasuries, right? Safest investment in the world then and still today, even given what we were talking about a little bit earlier. And that's great. There's nothing wrong with that. My approach is a little different. My thinking is a little different. I say if I've won the game, I can play it even more aggressively than before. So at that point, if I'm living on the portfolio, I'm not even going to bother with bonds anymore. Because bonds, while they smooth the ride, they're a lag on my performance. And one of the other ways I'm different in my thinking, Paula, is the classic thinking is the older you get, the more bonds you should have. But that assumes you're only investing for your own lifetime. And I'm not. I mean, my portfolio is going to outlive me. And I want it to be very productive for the charities I support and for my heirs. And so if I've won the game, I'm going back into all stocks. Candidly, something that I'm waiting for an opportunity to do as we speak. I was talking to somebody who said, and I think they were in a world fund actually, that they were only spending the dividend from their world fund, which if I remember correctly is about 2%. And was that safe? And in my world, that's about as safe as it gets, because you don't care then how the value of that fund fluctuates. If stocks go down for a while, you really don't care, because dividends are a little stickier than stock prices. Means they can go down in a prolonged decline, make no mistake, but more slowly and not as dramatically. And so if you're living on that dividend, there, or even the dividend on VTSAX, which I want to say is about 1.3, 1.4% these days, if you can live on that dividend, it doesn't get any safer than that. If I've got $3 billion and the market cuts me in half, and I've only got $1.5 billion, I think I could squeak by. Then I could know that it's going to return. So that's my way of thinking, which again is not traditional for your consideration.
Let's say we're not talking billions, but let's say we're talking few mil.
Okay.
Would your answer change?
The raw number that you have is only one part of the component, right? There's two components. There's how much do you have, and how much you spend each year. So let's suppose you come to me and you say, I've got $5 million. Mm-hmm. I am spending $100,000 a year. Well, you are well under the classic 4% withdrawal guideline, right? So yeah, to you, I'm going to say absolutely. If it's me, I'm 100% stocks. But let's suppose, on the other hand, you come to me and you say, I've got this $5 million and I'm drawing exactly 4%, and I need every penny of that, which I think is $250. Am my math correct?
Let's see. So it's 40,000 per mil. So 40, 80, 120, 160, 200. 200,000.
200. All right. You're drawing 200. So you're drawing every bit of that 4%, and you need that to meet your expenses. Then no, my answer is going to be different. You don't have that margin to play with. So again, it's not just a matter of how much money you have. And I'm making an assumption with the billions that you probably have a lifestyle that can get by on $1.5 billion, even if you have $3 billion. But to your point, and it's a very valid one for most of us, if you're way down in the few million.
In the single-digit millions.
In the single-digit.
Low single-digit millions.
Yeah, right.
Let's say you're in the low single-digit millions.
You poor devil. By the way, that's a pretty sweet place to be in my world. Then you're going to absolutely have to pay attention to what your spending rate is. And again, if your spending rate is modest, then yeah, you can push that envelope. If you're spending every bit of that, and maybe even a little more, then yeah, you're going to have more of those bonds. And by the way, I would say the same thing when you're considering your bond allocation going into retirement. So if you're going into retirement and you just barely have enough invested money to throw off at 4% what you need to live on, you're going to want more bonds. You don't have a lot of room to absorb that volatility. If, on the other hand, you're going in and whatever amount you have invested, you're only pulling 2% of it, then yeah, I'm probably going to be an all-stock. I love these questions. You have smart listeners.
They're very, very smart listeners.
Yeah.
Another listener question asked about how a person would invest on a 3-year timeline versus on a 10-year timeline. Let's say that there is a bucket of money that you want to spend within the next 3 years.
Right.
And then there is separately a different bucket of money that you want to spend within the next 10 years.
Right.
What would your approach be?
Yeah, so you're saving to buy a house or something, whatever.
Yeah.
Yeah, let's take the 3-year one first. So if you're going to spend the money in 3 years, I'm probably going to be in cash, especially these days where money market funds are back up paying 4 or 5% or whatever it is. Not too many years ago, as you recall, they were paying nothing. But even then, I would have been in cash, because stocks and even bonds, as we discussed a little bit earlier, become a little bit too volatile if you really want to have that money available in 3 years. But on the other hand, let's suppose you said to me, I want that money in 3 years to buy whatever, but I'm a little bit flexible. And then I might say, well, okay, add some stocks, because if the wind's at your back, it might get you there before 3 years, and you can go on that world cruise a little bit earlier. And if you're willing to accept the fact that the wind might be in your face and it might take you 4 years instead of 3 years or 5 years, then you can roll those dice. Mm. When you go out to a 10-year period, that applies even more. Because historically, there are very, very few 10-year periods where stocks didn't produce great results, right? There's a lot of 1-year periods where you'd be hurt, and 3-year periods, and even 5-year periods. But the longer out you go, the more reliable your stock performance is. So the more inclined I would be to roll the dice a little bit. But again, it depends on how absolutely positively you need that fixed amount of money at the end of the time period. Mm. And if you absolutely positively need it fixed, you need to be in cash.
That's actually something I talk about with this audience as well. And oftentimes, if it's something like a 529 plan, and assuming that you really want your child to be able to go to college at the age of 18 straight out of high school, and assuming that you don't have a lot of flexibility around that date, then you have a very, very fixed date for a thing like that versus something like a big 6-month trip.
Like, or even buying a house.
Yeah, or even buying a house. Yeah. Like, those are goals that might have some greater flexibility around the date. Is it really the end of the world if you buy a house in 2027 versus 2028?
Yeah, agreed. Absolutely. So it depends on what you're going to use the money for and how big a gambler you are, I suppose.
On the topic of adding bonds into the portfolio, this is also a listener question, quote, do you have a preference of slowly adding them to your portfolio over multiple years, or would you prefer larger contributions a few years before reaching retirement?
Yeah, that's also an interesting question. It goes back to what your risk portfolio is and how much you have. So using myself as an example, and I'm not suggesting this is what other people should necessarily do, but when I quit my last corporate job, which I did in 2011, the first time I stepped away from a lot of jobs in my career, but that was the first time I stepped away with the intention of never going back. I was 100% stocks when I made that decision. And so the next day is when I added my bond allocation. I'm not sure that's ideal. I think that you would be well served in most cases for most people to ramp it up slowly over the course of, say, 5 years and to begin adding those bonds just in case the day you happen to pull the trigger is a really bad day in the market or it's falling in a bear market year or what have you, and you don't want to be making the transition then. So that would be the more prudent, careful thing to do. I have not always in my life done the prudent, careful thing.
At what pace would you slowly add those in? Would it be like 20% a year per year over 5 years?
Probably I'd do something like that. Yeah, I wouldn't particularly want to overcomplicate it. If I happened, by the way, 5 years out, it happened to be in a bear market, I'd probably delay. And because bear markets tend to run their course, in 5 years is a pretty, now there are bear markets, to be clear, that have extended longer than that. We had, again, that first decade of this century, you had the stagflation years in the 70s and what have you. But for the most part, they'll run their course, so I might delay a little bit. If, on the other hand, it was a raging bull that had been going on for a while and stock prices were really high, to be clear, there's no way you can predict that they're not going to go higher. But at that point, I might be a little more comfortable shifting into bonds sooner and maybe even a little more aggressively than that 20%.
We received a lot of questions around what many people refer to as the decumulation phase, although to your point, during the quote-unquote decumulation phase, your portfolio might actually be growing. But the withdrawal phase or the retirement phase, we received a very large number of questions that were specifically around that. We've already talked about your suggested asset allocation during that phase, but this one question asks, and it's a little bit more broad, we know what your investment strategy is, but what safe withdrawal rate are you assuming, and what anticipated inflation rate do you use for planning?
So to answer the second part first about inflation, I don't. Because hard to know where it's going to go, right? It's sort of like taxes because those things change. And so if you look at something like the 4% guideline, that also typically doesn't look at those things. So let's rule that out. And then it goes back to what is the withdrawal rate. And I think 4% is a great guideline. There's a lot of conversation out there, not so much today, but a year or two ago about is the safe withdrawal rate really 3.92% or 3 point, and that's...
Yeah, there was it was like, 2018 or so, there was like a phase where everyone was obsessed with like, should it be 3%, should it be 5%?
I know. That phase, by the way, went on for a number of years.
Yeah, it really did.
And
that was when we were doing the Chautauquas in Ecuador together.
Yeah, I think that's when it started. That's when it started. But it lasted, right? I mean, I remember it even being more recent than 2018. And I don't know what I'm about to say is actually historically accurate, but if it's not, it should be. It's because it's a great story. It's evidently about 400 or 500 years ago, theologians were having serious discussions around how many angels could dance on the head of a pin. That's how this withdrawal rate conversation struck me. It's a little bit absurd. Bill Bengen, who's the guy who came up with the concept, makes the point that it's 4% is extraordinarily conservative, which is what his goal was, is to have something that would reliably survive the inevitable downturns of a long period of time. The market is corrections, bear markets, crashes are a perfectly normal part of the process that we all should expect and have to endure. And he took that into account in coming up with this 4%. And then the Trinity study comes along and did some in-depth analysis of actual 30-year periods and pretty much confirmed that's a good number. And it's good enough for me. You mentioned Chautauqua's a moment ago, and as you know, but some of our listeners might, because you were a speaker at Chautauqua, that people who attended could select a speaker to have a one-on-one conversation with.
Right.
And I'll bet that what I'm about to say will resonate with you, because I bet you would hear the same kind of thing. But one of the more common questions that I would get is somebody would come in and they'd say, just hypothetically, I have $1 million invested, which at 4% could throw off $40,000 a year. And I am in this soul-crushing job. But I need $50,000 a year, and that'd be 5%. What do I do? If you look at the Trinity study, 5% succeeds 86% of the time. I'm in a soul-crushing job, and this is what I would tell these people. I'm gone tomorrow. I leave Chautauqua, and the day I'm home, I'm resigning. I'm going to take that risk because 86% to get me out of a soul-crushing job. Mm-hmm. And then the second part of that I would throw in is, do you think that if you were uncomfortable pulling that 5%, there is a way, without your corporate gig, that you could make $10,000 during the course of a year? And Paula, you know this as well as anybody. Anybody who gets to that point,
right,
to that close to financial independence, is smart, resourceful, disciplined. I have never had a person say to me, no, I don't think I could figure out how to make $10,000, And the other thing is that a lot of these questions would come from young potential retirees. Mm-hmm. And I have yet to meet somebody, and I bet you will also agree and confirm this, I have yet to meet somebody in this space who retired early and then just sat on the beach for the rest of their life. Many times they'll go and do that for a few months. But again, these are smart, engaged people. So I also say to them, it's inevitable that you're going to do new things with your life, and it's equally inevitable that some of those things are going to throw off money. So yeah, go for the 5%. And Bengen, I think, has even said he toyed with making it 7% because that actually worked so often. And he just chose to be more conservative. And I'm a pretty conservative guy when it comes to that, so I like the 4% guideline. But as we said a moment ago, this idea of, well, should it be 3.29% is now we're just being silly. Right. Now it's angels on the head of a pin.
Bengen has been on this show multiple times, including most recently, we spoke face-to-face at the Bogle Heads conference. Yeah. And he made the point that 4.2% actually.
Yeah, right. I saw that.
He said 4.2% mathematically, if your lifespan extends out to infinity, like you can asymptotically be at 4.2% over a lifespan of infinity. So it isn't even a 30-year time span.
Right.
It's an infinite retirement.
I had forgotten that 4.2, and I'm pretty sure it was listening to your interview or one of your interviews with him that I was reminded of it. But I think 4.2 was his original recommendation, and 4% is just easier to remember. And that's how it became 4%. But yeah, to the same point we're making.
Yeah, like the rule of 72. It's actually like 69 point something. Yeah. Nobody can remember that many decimal points, so we all just rounded up to 72.
Exactly. Yeah. Exactly. And I think our friend Merriman that we were talking about earlier, Bennigan, my sense, and you obviously know him better than I do, is that he's a guy who's done his homework. I mean, he didn't just pull a rabbit out of his hat. I'm very comfortable with that kind of number. And great point that it's actually 4.2 and the whole infinity thing. I love it. Yeah.
Continuing on with this conversation around the quote-unquote decumulation phase or the withdrawal, the retirement phase. Let's see. Katie asks, and I think we've kind of covered this, Katie asks, please ask for more guidance around a decumulation account for retirement, asset allocation, and safe withdrawal rate. She makes the point that there's a lot of accumulation advice, but we hear less often about decumulation. And I think we've covered that. You've talked about asset allocation, which is essentially two funds. And
depending on how close to the 4% level you are, in my mind, determines how much percentage of bonds you need. By the way, a quick point on that.
Right.
you never want to have less than 50% in stocks. Because if you look at the Trinity study as a guideline, when you get below 50% in stocks, you no longer have the growth engine you need for that extended survival of your portfolio. In fact, I don't think I'd ever go below 60% being stocks. And the other thing, and you're right, we covered most of her question, but it gives me an opportunity to touch on another aspect of it, and this goes back to the 4%. So the 4% rule says you can take 4% adjusted for inflation each year, incidentally, and it will last for the duration. I would never take the 4% and set that on autopilot and not look at it. And there are two reasons for that. One, according to the Trinity study, about 4% of the time it doesn't last 30 years. You know, the market just, the wind is at your face too much, and obviously nobody wants to run out of money 30 years out. So you want to pay attention for that reason. If you get an extended down market, you're probably going to want to adjust your living or figure out a way to make a little more money. But there's an even more important reason to pay attention, and that is if you're pulling 4% over 30 years, the likely outcome is your portfolio at the end of that 30 years, let's suppose you start with $1 million, is not going to be running out. It's going to be 5 million or 6 or 7 or 8 or 15 million, depending on the market. Because of compounding, it's going to grow to extraordinary size. So you want to pay attention not only on the remote chance you might run out of money, but on the much more likely chance that your portfolio is going to grow, and presumably you're going to want to enjoy that extra money. And you do that by paying attention.
How often would you make withdrawals, or how often would you recommend a person make withdrawals? Annually, twice a year, quarterly, monthly?
My daughter's a good example. So she's in her early 30s. She's been following the simple path. She last fall stepped away from her corporate career. I don't know if this is permanent or is going to wind up being a sabbatical or whatever. You're listening to her now, it's she's really liking not being in the corporate world. But so when we went through her portfolio together, she did exactly what we're talking about. She added bonds, 20% in her case. And I said the first thing you want to do is, instead of having your dividends from VTSAX reinvested, which is what you should do when you're accumulating, now you want to reach out to Vanguard or whoever your provider is and say, I want you to send me those dividends. I want you to drop those into my checking account. And if I'm remembering correctly, pays quarterly, maybe twice a year, I don't remember. But anyway, have that done. And then you add the bonds, and VTSAX, which is the total bond market fund, is thrown off, I want to say 3.6%, something like that. So you want to have that thrown into your checking account as well. And if 4% is your target between those two at an 80-20% allocation, you've accounted for about 2.5% of your 4%. Have I confused anybody yet?
Yeah, no, that makes sense.
Okay.
Just to outline the math
Sure.
in case anybody wants to. So 80% of your portfolio is, in your daughter's case, you're young and you're an early retiree. 80% of your portfolio is in equities. You're pulling the dividends out of those equities.
Right.
And those dividends are at what percentage did you say?
I think it's
ballpark.
Yeah, it's like 1.3, 1.35, something like that.
Okay, yeah. So essentially, from 80% of your portfolio, you're pulling out 1.3% in dividends.
Right.
And from 20% of your portfolio, you're pulling out ballpark 3.5% in dividends.
Exactly.
And so you mash up the two of those.
And it comes out to about 2.5% of the 4% you want to have to live on. So now the question becomes, well, where do I get the other 1.5%?
Right.
And the easy thing you do is you, again, reach out to Vanguard. You can either do this whenever you need the extra money, or you can set it up and Vanguard will do it automatically, and you calculate how many shares you need to sell in order to accumulate that 1.5%. And you just instruct them every month, every quarter, whatever frequency works for you and your spending habits, sell these shares and shift that money into my checking account, and you're done. And then, if, especially for younger people, let's use my daughter for an example. Let's suppose 5 years from now she's, I'm going to go back to the corporate world. Or maybe she starts a business that starts throwing off some cash. Well, now you shift back into 100% stocks. And now you tell Vanguard, start reinvesting those dividends, and you're back to accumulating. It's an interesting time. When my dad's generation came of age, if you were lucky, typically, you came out of school, you got a job, you worked for the company for 40 years, you retired with a gold watch. For my generation, and this describes my career, you came out of school, you found yourself in an industry, in my case it was magazine publishing, but you probably went to a variety of different companies within that industry. In my case, whoever would pay me more money, okay, I'll join you. And that was it, and that made it interesting because I got to work for different companies. I think today what's really exciting for people younger, and like my daughter, is they're going to have multiple careers in multiple areas, and I see Jessica doing that already. So who knows what her next phase will be. I mean, well, right now she's in her next phase, but what follows that? And if it starts throwing off significant money for whatever reason, then she's going to shift back her allocation into that growth phase, that accumulation.
Let's say that she, in a year or two, says that she wants to start a business, but she's going to need some startup capital for that business. How would you recommend that she allocate that amount of money that she would need as startup capital as it relates to her overall portfolio?
Yeah, so first of all, if you're in the position that she's in, where you have enough that you can step away, you have capital. Mm-hmm. And now the question becomes, do you want to use your capital? Do you want to find outside financing, in which case you've got to give up part of your company, and those are tough decisions. I would also say you want to be very, very careful because you've worked hard to put yourself into a very strong financial position. And starting a company can be a wonderful thing to do, and it can be extraordinarily lucrative, but it's also risky. A lot of companies fail. So think long and hard before you take that step, and how much of your money you pull out of your portfolio to support it, understanding that if it doesn't work, you've rolled a very good situation back and you're going to have to rebuild it. So there's no real easy answer to that question, but it's an important one to give long, deep thought to.
But if she answered, let's say she thought about both, and her answer is, I want to bootstrap this myself in order to retain full control, and I do want to go through with it. What should the parameters be when it comes to balancing the public equities or public bonds portion of the portfolio, public markets investments, as opposed to a company that you yourself are starting?
So if I'm understanding you correctly, the first question I'm going to ask is, how soon are you going to have cash flow? How soon is this company going to be providing money for you to live on? If the answer to that is, well, it's going to take a while, then I'm going to hang on to my bonds because I need that to smooth the ride. If the answer is, no, I've got customers right now, day one, I'm going to have cash flow, and I'm going to divert a lot of that to grow the business, but I can take some of that to live on, then I'm probably going back to all stocks. Is that, did I hit your question right?
Yeah.
Okay.
To your point, a lot of companies do, because you mentioned both product and service. Yeah, a lot of companies, especially if they're bootstrapped, will start as service in order to create the cash flow and then use that cash flow to develop product. That's what I did. Yeah. Start a service and then later develop product.
Yeah, you're a classic case of what we're talking about.
Yeah, exactly. That's why, it's actually why I asked. That's something that I think about a lot is how do I balance my overall portfolio with regard to the real estate portion, the private business portion, and then the public equities portion.
I have a little bit of the same experience because when I quit my corporate job back in 2011, and that's just when I happened to start the blog, I happened to start this journey, but I didn't start the blog with the idea of it being a business. And I had no idea of doing Chautauquas. I had no idea of writing books. I was just trying to archive this information for my daughter because I'd managed to turn her off to hearing it. Right, and I wanted to make sure it was there. The blog started to grow and then suddenly was making money. And then I wrote a book that turned out to be well received, and suddenly I'm getting royalties. I still own bonds from when I left that corporate job. And one of the reasons is this all feels very temporary to me. I keep thinking, okay, it's been great, it's a great ride, but it's going to go away, and I still need my bond allocation. There was a guy, I'm drawing a blank on his name. I bet you met him because he and his wife came to several Chautauquas. And nice people, we stayed friends, and my memory is just shot. But in any event, every time I gave a talk at talk with in the Q&A section, he would raise his hands and he'd say, how come you still own bonds? Because based on what you're telling us, you should be 100% stocks. And he was right. And I'd say, well, I just, this kind of thing I just said now, and then the next year he'd show up and you still have those bonds? Well, I still have them today, to this day, and I should have dumped them a decade ago.
And that goes back to your earlier point when you say people who retire, especially if you retire young or early, often are highly engaged with the world. And because generally you're interested in things, you're intellectually curious, you're highly engaged with the world, oftentimes you end up kind of accidentally making money.
Perfect example of what you just said, with one exception. I wasn't young. I was 60 when I pulled the trigger. But yeah, I had no intention of ever having an income again.
Right.
And yet here we are. It's almost impossible for it not to happen if you stay engaged. And it's fun.
Well, and arguably, you're 74, arguably you're still quote-unquote working.
Absolutely.
If you consider talking to me a job,
And how much better can a job possibly be than sitting here and talking to my friend? In one sense, it's work, but it's joy. I mean, we were talking to each other. Well, I don't know, maybe the blog was making money by then, but it wasn't making enough for me to get rid of my bonds. So I was doing this before it threw off money just because it was fun.
Yeah.
And the fact that it's throwing off money makes it more fun, but yeah.
It gives you the capital to reinvest. The fact that it makes money gives you the capital to allow it to grow, which is, to me, that's been like the fun part. For me, it's been building out that team, building out that support, really being able to invest in the growth of this.
And I imagine you can also relate to what I'm about to say from your Chautauqua experience and having your one-on-one sessions. But another thing that would commonly happen is I'd have a conversation one-on-one, and they would show me their numbers, and they would be financially independent and not have to work anymore. And they'd say, but I love my job. I don't want to quit.
Yeah.
Well, there's nothing that says you have to quit. Being financially independent just means you get to choose. And so if you want to quit, go ahead and quit. If you love what you're doing, then keep doing it. I was talking to a young Chautauquan just last week that we've stayed in touch with, and he's closing quickly in. He and his wife are quickly closing in on being full FI. He's an engineer. He loves what he does. And he said, JL, what financial independence means to me is not that I'm going to stop working at my job, but I'm going to be much bolder in the way I approach it. And that's probably going to take me further in my career because I have that FU money that allows me to make those bold choices because I'm not dependent on the check.
Right.
Yeah, and you will probably do even better. So, yeah, there's so many reasons to walk this path.
Exactly.
But,
Exactly. A point that I often like to make is that the people that we think of as conventionally quote-unquote wealthy, the majority of them are financially independent. Justin Bieber, I don't know what his spending is like, but I assume he's probably financially independent. Taylor Swift, right? Taylor Swift.
One would hope.
Yeah, exactly. She didn't go on the Eras tour because she was worried about paying the rent. Warren Buffett, right, who just announced his retirement at the age of 94.
The slacker.
Yeah. And so these people who we think of as conventionally wealthy, they're all financially independent. So no one's going to drag you kicking and screaming away from your job. And in fact, it gives you the opportunity, as you said, to be bolder in the decisions that you make, to take bigger risks, to reinvest in growth, just to be louder, right? You just get to be louder.
And have more agency. The running thread through all the people you named, and this includes you and me and probably a lot of people listening, work is not the problem. People love to work because it makes them productive. It gives them great satisfaction. The problem is when you have to work and you don't have agency, right? All of those people have agency. And that's what makes the difference. If you're working in a job, paycheck to paycheck, because you have to pay the rent, you no longer have agency. And it may still be a good situation. You may be working for a company you love and be lucky enough to have a good boss, But that can change. Your boss can go take another job or get promoted, now suddenly you have a boss that not working out for you so well. So that's the critical difference. So a lot of people, because they get in these soul-crushing jobs, think, man, work is just terrible. Work sucks. It's not the work. It's the fact that you're working without agency. And everybody you described has enormous autonomy over what they do. They can choose to spend how their time. They can choose to whether go on tour or not. You can choose, how, in your case, how many podcasts to do, how many guests to have. I can choose how many I go on. I can choose whether to keep writing or not. That makes all the difference.
Right. Yeah. Mastery, autonomy, and purpose are the three biggest predictors of workplace satisfaction.
Well said. Yeah.
We'll close out kind of on what we were just talking about, autonomy, mastery, purpose, on this question, which also comes from Chen. Advice on the spending phase. What advice do you have on the spending phase, especially if it's a big pot of money, if you have lived below your means all of your life, and if you have philanthropic thoughts?
So another question I love, because this is a topic that has been pretty hot in recent years in the space. And it's been hot in a way that I object to. And what I mean by that is the push recently seems to be, if you have money, spend it.
Die with zero.
Not the only, but the classic example is die with zero. There's a lot in that book to love, and there's a lot in that book that makes me uncomfortable. What I would say is a couple things. First of all, the idea that money in general, or that spending money specifically, is a key to happiness is a fallacy. Right? Money can do a lot of things. As we've already had in this conversation, it can open magnificent paths to you that wouldn't exist otherwise, great opportunities. I'm an advocate of accumulating and having money for those reasons. Money solves money problems, as somebody smarter than me once said. It's not the key to happiness. So if you think spending money is necessary to be happy, I would suggest that you do a little soul searching. Okay? Now, having said that, if I'm talking to somebody, and again, it takes a certain frugal mindset to set aside the money to invest to get to where we're talking about. When you've arrived, when you've become wealthy, when you're financially independent, what served you well to get you here is not necessarily what's going to serve you well going forward. I would never say spend the money just because you have it. It's not what I do. But if you said to me something along the line, man, flying has just become really uncomfortable, and I could afford to fly first class and that would make it a little less miserable, but I just can't bring myself to pay what they charge for that, I'm going to say you're making a mistake. I fly first class everywhere I go now because it makes life a little less miserable. I'm a little appalled at the premium they require for that, but I'm happy to pay it, and my life is a little better. I don't drive a fancy car. I could easily afford it because I just don't care. And just because I can easily afford a fancy car doesn't mean I'm going to go out and buy one, although I think there are people out there who would say, oh yeah, you should do that. In fact, not only does it not appeal to me, these days luxury cars are defined by having more and more complexity, more and more computer, more and more screens. Last thing in the world I want. When I go to buy a car, I walk in and say, what's the most basic car you have that has the least technology in it? That's the car that I want. If you look out there and there's a way that spending money would make your life better, and you've got plenty of money and you're not spending it, yeah, you need to adjust that thinking. But if somebody says to you, Paula, you got plenty of money, you should be spending it on this, that, or the other thing, and these are things that you just don't value, you don't care about, or in the case of a fancy car for me, would actually make your life worse? No. Now, to the philanthropic part of it, and this is a great example, I would rather give my money away than buy that fancy car. I'd rather go buy a $25,000 or $30,000 Subaru, which happens to be the car that we've been driving in recent years, over a $100,000 Porsche equivalent, and I'd rather give the remaining $75,000 away. For a couple of reasons. I think, A, it does more good in the world, but B, it's just more satisfying to me. One of the remarkable things about giving money away, and maybe this isn't universal, but I imagine it's pretty close to it, is there are few things that give you more joy with your money than giving it away. So from a purely selfish, let's suppose I've got that $100,000 sitting there, and I say, okay, I can buy this Porsche, or I can buy this Subaru, and I can give away the other $70,000, $75,000. The move that is selfishly going to benefit me the most, selfishly give me the most happiness and satisfaction, is giving that money away. I mean, setting aside whether it does any good in the world, just from a purely selfish point of view. And the fact that it makes the world better is, I think, part of the reason it makes it so satisfying to do. That's how I think about it. And I think that's one of the reasons that wealthy people, by and large, in spite of the stereotype, are enormously generous. And I think part of it is that they're just good people who want to make the world better. But candidly, there's a whole lot of satisfaction to doing it in ways that you don't get anywhere else.
Yeah. We had Robert Rosencrantz on the podcast recently. He's a billionaire. And I just learned this last night, actually. He was on the Time 100 honorees list for philanthropy. He's a big fan of Stoicism and the Stoic philosophy,
Right.
but he spoke with great passion about the same concept, about taking responsibility, some level of responsibility for creating the type of world that you would like to see. The only inevitable choice then is philanthropy.
Right.
And he's very involved, personally deeply involved,
Right.
in the philanthropic projects that he funds.
Right. Yeah, Bill Gates does that. Warren Buffett is doing it. It's contagious, too. I can give you just a very small example from my own life. Back when my daughter Jessica was in second grade, we were living in the Cleveland area, and she was going to Catholic school. They were always raising money, and one of the things they would do is have charitable auctions. I don't think it's there anymore, but there was a restaurant in Cleveland that we really liked called Parker's. Parker's was a fairly expensive place, especially for back in the day, but it was really, really good. And Parker, the guy who owned and operated the restaurant, his donation for this auction was dinner for 12 at his restaurant. And when that came up for auction, I turned to my wife and I said, let's win this auction and gift it to the teachers at the school.
Oh.
I'm getting chills saying it because it gave us so much joy to do it. It also, by the way, gave us an enormous advantage in the auction because everybody who's bidding against us is mentally calculating, okay, Parker's is about $100 a person, so this is worth about $1,200. So if I can get it for less than $1,200, I'm going to do it. That's not our calculation. We don't care. The bidding kept going up and up and up and up, and it got up to that $1,200, and then I was willing to go over it, and then it stopped, and we won the auction. And the problem was there were more than 12 teachers. And so when I gifted it to the Mother Superior, afterwards in conversation, I said, I have one caveat, and that is you can't give your spot away. You have to go, because I knew she would do that otherwise. Somebody else in the crowd who was standing around heard me say that, and I think there were maybe 16 teachers rather than 12. And this person stepped up and said, you know what, I'll cover the dinner for the other 4. And then somebody else heard that, and they stepped up, because wine wasn't included. And they stepped up and said, you know what, I'll cover the wine for the dinner. Now, why didn't those 2 people bid on the dinner originally? Why weren't they bidding against me? Not because they're not generous enough. It just didn't occur to them. I don't know why it occurred to me. It just happened to. But it has a magnifying effect. They had the same instincts that I had, and they were obviously getting the same joy of doing it. And so I think when you engage in this, it inspires other people to engage in it. It doesn't, in my mind, create generosity that wasn't there, but it triggers something in them to say, wow, that's a cool idea, and I could do that, where it might not have occurred to them otherwise.
It activates it.
Yeah, and there are few things that I've ever spent money on that have given me selfishly more pleasure than that. Yeah, I think it's a good thing to do.
Excellent. Well, thank you for spending this time with us. Where can people find you if they'd like to know more?
Well, first of all, it's been entirely my pleasure, Paul. Thank you for having me. I'm so glad we made this work. So the easiest way to find me, I suppose, is still the blog, which is jlcollinsnh.com, and then from there you'll find links to my 3 books, and I'm on X and I'm on Facebook, and so that's about the extent of my social media, and there you go.
You still don't have TikTok yet, huh?
Still don't, and probably never will, and the world can thank me for that later. Yeah.
Excellent. Well, thank you again.
Entirely my pleasure.
Maybe we'll go back to Ecuador again sometime.
It sounds like a pleasure. I would love to get back there, and if I remember the name of this little fishing village, that's where I would suggest we go and hang out.
Excellent.
Yeah.